Hello everyone, and welcome to the specialist trading presentation of the right way to trade tops and bottoms. Thank you. Welcome once again. Thanks for taking time out of your St. Patrick's Day and joining us. This promises to be a great presentation. I'm going to be teaching you a technique, an entry technique, which was taught to me some 30 years ago on the floor of the Pacific Stock Exchange, and what I feel is the correct way and the only way you should ever trade tops and bottoms. Welcome once again. My name is Primo. I am the president and founder of Specialist Trading. For those of you who are unfamiliar with my website, we are first and foremost an educational company. It is our goal to teach and educate all of our students and all of our members so that you can ultimately make your own trading decisions. What I do is I give you all the knowledge and expertise that I've accumulated in my 38-year career and then mentor you and stay with you, basically trade right alongside with you so that you can fully understand the process and make your own decisions. Because it's our philosophy at Specialist Trading that the reason why most traders fail is because basically you're giving your power away. In other words, you're listening or depending on something to tell you when to buy, when to sell, what markets to trade. We want to give you all the information that has stood the test of time, and then you make the correct decisions. It's the same way I was taught. I started trading some 38 years ago on the floor of the stock exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist for DLJ. I traded through the crash of 1987 and the bull market after that. And in the mid-90s, I left the floor to manage money and to pursue my own trading. So I've seen and traded and heard just about every market environment imaginable. I know what works in terms of consistency. I know what does not. And so that's why we teach all of our students all the things that I've accumulated. Now, as I stated, I have a great entry technique. This is not a full-fledged strategy or system. This is simply an entry technique, but you can apply this very easily onto any trading method that you currently have. As well, you can construct a method, and I'm going to show you exactly how easy it is to implement. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you a lot of performance results today using this entry technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. We are required to show you this, so as you're taking a moment to view this, I'd also like to invite each and every one of you to follow us on Twitter. Here's our handle right here, abbreviation for Specialist Trading. It's at SPCLSTTRADG. If you go there every day, you'll see that I post something new and knowledgeable, education, anywhere from daily financial wisdom to actual signals that we're currently in. I show different techniques and different tools that we use at Specialist Trading. So feel free to follow us. Once again, that's our handle right there. Now, for those of you who have followed us, you know that we've teamed up with Pro Trader Strategies. They are our sister site. They market and promote all of my courses and all of my strategies. They also have a Facebook page. So you can log on there at protraderstrategies.com on Facebook, and you can also get a lot more information about what we do. They have a lot of videos, free videos, educational videos of me speaking as well. Okay. Now, as I stated, we are first and foremost an educational company. Now, we provide all of our students and all of our members with courses and strategies in these courses so that you can learn where to buy, where to sell, where to place your stop, where to place your exit points. But really, they're just basic formats because we want you to ultimately decide how to implement them. In other words, we give you all of the tools, all the pieces of the puzzle, and you can decide whether you want to trade it conservatively, whether you want to trade aggressively, if you want to use one of the many options for your entry, or you want to use one of the many options for your exit. Why? Because we feel everyone trades differently. It's not our belief that any two traders should trade the exact same way. This is a recipe for a disaster. Now, another reason what we do is we don't rely on conventional wisdom. That's another reason why we feel most traders fail. Conventional wisdom, which I've learned over years, really has no consistency to it. And this is what I learned on the floor of the exchange. This is what I'm going to share with you. Because when I first started trading, I've made no secret about it, I really had a very difficult time. In fact, I struggled my first year or two where I couldn't really make any money. I couldn't seem to go forward. I'd have 3 or 4 great trades, and then the 5th trade, I'd give everything back. I know a lot of you are probably going through the same exact scenario right now. It's extremely discouraging, very frustrating, but there is a remedy. I want you to know, because my mentors were able to trade my trading around. These were actual specialists on the floor as well who were able to turn my way of thinking and trading around. And this is what my goal is as well, to teach you the same things that were able to turn my trading around. So my goal is to teach you, not to trade for you, not to simply give you and force feed you signals so that you blindly take them the way so many other websites do, but to teach you how to trade with the specialist edge, okay? The same edge that was able to turn my trading around, that has enabled me to trade for roughly 38 years now. Okay, so with that said, just a couple of things before we begin. This is a class, so I want to hold it as such. So if you have any questions, kindly wait till the very end. I know a lot of other educators like to take questions during the course. It's a little bit different for me because I like to give the information and wait till the very end. So if you have any questions, kindly write them down, or just wait for them, and I will get to them at the very end of the course. Also, I will answer only one question actually, and most people ask this: is this being recorded? Yes, it is. So if you happen to have to leave early, or if you have some technical difficulties, just kindly contact the people at Pro Trader Strategies, and you see here in your chat box on the far right with any questions or anything, you can email or call them, and they will send you the link to this recording. Okay, so here's what you're going to learn today. Excuse me. I'm going to share with you how most people trade tops and bottoms, and I'm not saying this from an arrogant point of view. I'm saying this actually from firsthand experience, because this is the way I used to trade. This is the way I was taught. I was taught to trade tops and bottoms this way. Let's start out with stocks, and I'll start off showing you some older charts, but these are just for educational purposes only. Then we'll share with you some examples that are as recent as yesterday. All right, let's look at this first chart of Cat Tractor here. As we see, we have the chart in front of us, and below we have one indicator plotted. It's your standard slow stochastic. Now, for this technique to work, it doesn't really matter what indicator we're using, just as long as it tells us that we are in the so-called overbought and oversold territory. Now, with this specific oscillator, we can see here that the threshold, which is this blue line, which I believe is at 80, anytime we're above that, this is telling us that we are in so-called overbought territory. And with this lower threshold at 20, anytime we are below that, we are in the so-called oversold conditions. So obviously, conventional wisdom tells us that when something is oversold, it has sold off too much and gone down too far too fast, that is when you want to buy. So if you would use this simple tool, well, you would have bought here, and guess what? You would have had a very nice rally and a very nice profit, about 5 or 10 points. And then you simply wait for price to, or the oscillator price to go above into the overbought territory, which gives you the signal to exit your long. And now, if you're aggressive enough, you can switch and go short. So at this point, you'd sell, and guess what? You have another winning trade. It goes straight down after that, and you've got a nice profit. And as you can see here, we are now in the oversold territory, so you cover your short and you decide to go long. At this point, you're probably thinking, this is just too easy. All the books and everything I've read are perfectly right. Conventional wisdom is right. Just buy when something is oversold and sell when something is overbought. So you jump in the water one more time, and you purchase Caterpillar tractor, but this time it doesn't go up. Okay, well, you figure, well, that's okay. You're looking at the indicator. It's still in the oversold territory, so it can't be oversold for too long. After all, everything you've read or the courses you've gone to, the seminars, they tell you that it's bound to bounce, so you double up and buy some more. So now you buy some more, and it goes up a little, but it doesn't go all the way to overbought again, and now it's back in the oversold territory. Well, now you decide to triple up because you really don't need it to go up that far to break even or to start making some money. And after all, you've had 2 really good trades. It's bound to bounce up a little bit more. So you triple up, and guess what? It goes even lower and lower until you've basically given everything away that you made in the first couple of trades. Does this look familiar to anybody? This is the way my trading used to be on the floor. I would have 2 or 3 great trades, but then the next trade, I'd give everything back. Now, this also can be transferred over onto intraday trading. Let's look at the E-mini S&P. This is an older chart. It's a 5-minute chart of the E-mini, but we have the same slow stochastic oscillator plotted. We have not altered anything. In fact, I didn't even go into the edit box. All I did was click on slow stochastic. I didn't change anything or alter anything. Same parameters. So we are in the overbought territory. So you decide to sell, and you have a nice trade. The E-mini goes down in a 5-minute time frame until you get into the oversold territory. So you cover your short and you buy. And now it goes back up about another 5 points. So you figure, boy, this is fantastic. Now I'll sell and I'll go short. So you've had, once again, 2 or 3 great trades under your belt. At this point, you'll probably reach higher by the end of the month. It's just too easy. So you sell, and guess what? It goes higher. But that's okay. Once again, we're still overbought. It can't stay overbought forever, right? So you double up, and it goes even higher. You triple up until finally, once again, you've given everything back. We just looked at a daily chart in stocks. We see the same concept now on a 5-minute chart on the E-mini. And it just doesn't end there. We can also go to the Forex markets for all you currency pair traders. If we look at an older chart of the Swiss franc, we see here that the indicator is in the so-called overbought territory. So remember, all the courses, all the books we've read, all the seminars told us that when something is overbought, you have to sell. So you decide to jump on in and sell, and it doesn't go down. So you just sell more, and finally, your entire account is wiped out. Now, this is the thing we're trying to stay away from at specialist trading. Why? Because this is what almost lost me my job as a specialist on the floor of the stock exchange. Because I traded this way. All the books said when something is overbought, you sell, and something is oversold, you buy. And it would work until it didn't work. So I really didn't think there was much more time for me working on the floor because I just couldn't seem to make ends meet. I would, once again, have a couple of good trades, give everything away, have a couple of good trades, give everything away, and I was just basically treading water. I had nothing to show for all my hard work. Now, there were a couple of other traders on the floor who had been trading some 30 or 40 years. These were specialists themselves who saw how frustrated and how discouraged I was. And here's what they taught me. They said, Steve, here's the one mindset you have to grasp onto, that you have to make sure that you understand. Because most of conventional wisdom and most of the things we've been taught are wrong. And so what they told me was, there is no such thing as overbought, oversold. I'm going to repeat that again. You may want to write this down. There is no such thing as overbought or oversold. Now think of it. We've all seen markets, regardless of time frame, regardless of the market, go as high as they want. You've seen markets continue to go higher and higher and higher. They've been in the so-called overbought conditions for weeks, if not months, if not years. And conversely, we've all seen markets, regardless of time frame or what market, be oversold for weeks, months, and years. We've even seen equities issues go down to zero. Does anyone remember Enron? So the point is, it is a recipe for disaster to try and pick and sell something when it's overbought and try and pick a bottom when something is oversold. There's no consistency in that way of trading. Sure, it will work every once in a while, but over time you will not have anything to show for it. Take it from someone who used to trade this way. Go back and look at your own trading if you've been trading this way. Okay? If you've been trying to short things when they're going up and try to buy things when they're going down, see how consistent you've been. I'm not saying you haven't had winning trades, and I know there are some traders that make a good living trading this way, but they're probably the upper 5% of all traders that can trade this way. The majority of us, the 95%, myself included, aren't able to trade this way with consistency. You see, these other traders are probably seeing something that the rest of us don't see, or they have some type of internal indicator or internal chart where they're able to know when a top or bottom is being formed. But the rest of us, are unable to locate or identify this. Remember, we're trying to get consistent in our trading. We're not trying to hit home runs. So I had to really grasp onto this mindset that there is no such thing as overbought and oversold. And the minute I did, the minute I truly believed it and I started seeing for myself in all markets and time frames, that's when my trading started to turn around. So if there is no such thing as overbought or oversold, then what is the right way to trade tops and bottoms? Well, my mentors taught me that the right way is to simply go with them. All right, so what does that mean? How do we go with a top or a bottom? Here's the technique I'm going to be sharing with you today. Once again, this is just an entry technique. I know a lot of you may be saying, well, after I present this, you'll say, boy, this is fantastic, but where do I exit? Where do I place my stop? Please remember that I'm only giving you one piece of the puzzle today. If you've been trading for, longer than 2 weeks, you'll be able to figure out how much you want to risk and just simply place a stop. You'll be able to say, well, if I'm risking, a couple $100, well, then maybe I want to exit with a twice that much of risk. So if I'm risking 200, then I'll exit once I get to 400. It's not that difficult. The main thing is we want to fine-tune our entry, and this is what this technique does. All right, so let's start out with the charts we looked at earlier, and then let's share with you exactly the right way to trade this technique. Once again, if you happen to have any questions, we will take them at the very end of the class, okay? All right, so here's this chart, once again, of Caterpillar Tractor. Now, before we tried to trade the tops and bottoms, we had some success with them, but then when we tried to trade a bottom here, we just literally gave everything back. Here's what my mentors taught me. They said, regardless of what market and regardless of what time frame, you must always add a specific indicator to all of your charts, and that is simply the 50-period simple moving average. I don't care if you're looking at a 5-minute chart, a tick chart, or a monthly chart, or a daily chart, as we see here. Always add a 50-period moving average and ask yourselves, where is price in relation to the 50-period moving average? Okay? I'm going to say that again. You may want to write that down as well. Where is price in relation to the 50-period moving average? If price is above, then the only thing you will be doing is looking for buy setups. I don't care what strategy you use. It doesn't even have to be this technique. It can be something else. But if price is above, you should only look for buy setups in whatever trading plan you're using. But if price is below, as it is here, then we're only looking for sell setups. That's it. That's as simple it is. This is such a simple but powerful technique. If I were stranded on a desert isle, I could only use one technique that I've learned out of the hundreds of techniques. This would be the one I would pick, because this has saved me so much money by being able to know where I should buy or whether I should sell. So looking at this now, there is no way I was thinking of ever going to be trying to pick a bottom in Cat Tractor. All I'm looking for is setups to go short. All right, so how do we find the setup now with this technique? Well, we can still use this slow stochastic. And one thing I want to explain here, it does not matter if we use a slow stochastic such as I've plotted here. It could be any overbought, oversold tool. Okay, it can be any oscillator that tells you something is overbought, oversold. It can be something that you've created. It can be a standard tool that you find on your charting platform. It could be someone talking on TV telling you the markets are overbought, oversold. It does not matter, okay? Because why? Because we're going to exploit overbought and oversold conditions. So we don't care where it's coming from. We're going to exploit it. So since we're only looking for sell setups, we want to identify all of the so-called oversold conditions, as we see circled in red, okay? Now this is where this specific tool told us the market was oversold. All right, so we want to exploit that by identifying all of the short-term bottoms that were created when we were in the so-called oversold conditions. Now we see here with these red horizontal lines, this is where a short-term bottom was created. As you see here, we came down and then we bottomed out, and this was coincidentally when we were making a so-called oversold environment. Now there was a bottom here and a bottom here. We don't care about those because we weren't in the so-called oversold. But once we get to those oversold, that's where we want to identify these bottoms. And the way this entry technique works now is if those bottoms, if those short-term bottoms are violated by 1 or 2 ticks, well, that's where our entry is going to be. And that's it. Now we have about 3 or 5 winning trades in a row, as opposed to 2 or 3 winning trades and then the rest of them total losers. Okay? Why? Because we're in sync with the 50-period moving average and we're exploiting oversold conditions because we now know that there's no such thing as oversold. Let's look at that 5-minute chart of the E-mini. What's the first thing you do regardless of what strategy or technique you're using? The first thing you do is add a 50-period moving average and ask yourselves, where is price in relation to the 50? Well, in this case, price is above. So what does that tell us? Are we going to short the E-mini? No, we won't even consider shorting. I don't care if some trading guru or some guy in a chat room tells you to go short. We don't care. We're only looking for buy setups. Over time, this simple technique will give you so many, really high probability setups as opposed to, maybe 2 or 3 great setups and then the rest of them terrible. So since we're going long, now using this entry technique, we want to exploit so-called overbought areas, which are right here, circled in green. Remember, once again, it does not matter if we use the slow stochastic. It could be any momentum oscillator. It could be a tool you devise. Once again, it could be someone in a trading room telling you the markets are overbought or oversold. And so once we've identified the so-called overbought conditions, we simply locate all those short-term tops that were created. And if those tops are violated by 1 or 2 ticks, we simply jump on board and buy. Now we have nothing but winners. Before we had 2 or 3 winners and then we gave everything back. Now we have nothing but winners. Lastly, let's look at the Forex markets, okay? First thing we do is we add a 50-period moving average. We ask ourselves, where is price in relation to that? Price is obviously above. So that means we're in no way going to consider shorting the Swiss franc. Now, obviously, the Swiss franc is going to have to top out sooner or later and go below. That's okay. When it goes below, then we'll change sides and start to look for shorting setups. It's that simple, okay? Obviously, you're not going to be able to have every trade a winner, but you're going to be consistent by being on the right side of the market, and that's the name of the game. You see, consistency is what will sustain you, not some fly-by-night system that promises the world and then goes into a huge drawdown and gives everything back. You know, home runs are great, but they can lose just as much and give everything away. I know tons of traders on the floor who made tons of money and then gave it all away, and none of them are trading anymore. My mentors taught me that consistency is what will ultimately enable you to be trading 10, 20, 30, 40 years down the road. So this is what will sustain you, consistency, not some technique that promises the world. So we realize that not every trade is going to be a winner. We just want to be on the right side. So if price is above the 50, we're looking to exploit the so-called overbought territory. We identify the tops that were created in that so-called overbought condition, and we simply buy 1 or 3 pips above. And now before, where we had all losing trades trying to pick a top because the market was in so-called overbought conditions, we have nothing but all winning trades. Okay? Why? Because we are in sync with the market, and secondly, because we now know there is no such thing as overbought or oversold. Now, if we look here, the Swiss franc was oversold for overbought for months, and it kept going higher and higher. So it's really silly to try and think that you can pick a top or a bottom with consistency. It may work every once in a while, but over time you'll have nothing to show for it. Okay, so let's look at some recent examples. Those examples were for educational purposes. Let's show you some recent examples so that you can understand this technique and see how it works in the last month and even in the last couple of days. Let's start off with stocks once again, and we'll look at the letter G. Obviously, we see that price is above the 50, okay? So what does that tell us? It tells us that we're only looking to go long letter G. This is a current chart coming up into the first week of March. There's no way we're going to try and pick a top. If you had tried to pick a top, you had to be getting in and out really quickly. It's much easier simply to identify all of the so-called overbought conditions on this particular oscillator, then locate all of the short-term tops, and simply buy when those tops were violated. You see how you have all these number of winners. If you had taken just the very first setup here, roughly around 19.5, 19 3/4, you would have made 3 or 4 points just in the next month on a relatively inexpensive stop. How about letter X? Okay, this is an older chart coming into February of this year. In November of last year, we crossed below the 50-period moving average. So what does that tell us? It tells us that right here, after you had 2 or 3 closes below, that you're only looking to go short steel. That's the only thing we're going to be thinking of. If you had tried to pick a bottom here, do you think you would have had a profitable trade? But this is the way most traders trade. This is the way I used to trade. When something is oversold, when it's gone down too much too soon, according to some silly indicators or tools we're following, we always want to buy because we feel we're picking up prices at really inexpensive prices. But what's inexpensive? 34, 30, 24, 22? And look at the entire time. We were oversold almost the entire time. So there's no such thing as overbought or oversold. You can continue to be oversold for weeks, months, years. Now that we know this technique, we're below the 50, so we're only going short. We identify all of the bottoms that were created in the so-called oversold scenario, and that's our trigger. If we trade 1 or 2 ticks below, we enter to go short. So now if you tried to pick a bottom in X, you wouldn't have done very well. But if you'd used this simple entry technique, you think you would have had some nice trades? Remember, once again, if anyone came in late, we're simply sharing with you an entry technique. I don't think it's very difficult if you've been trading for a little while to figure out where you'd want to place some stops and where you want to exit. It's totally up to you. But we're showing you and sharing with you the rules for this specific entry. How about CI? Okay, this is coming into this past week. Obviously, price is above the 50-period moving average. In other words, someone could say, well, Steve, for right here, we had 2 closes below. That's true, but you're not simply going to sell something because it's below the 50. You have to wait and see that, first of all, whatever tool you're following is in an oversold condition. Did this ever get into the so-called oversold? No. So you had no setup here. So it's much easier just simply to identify the so-called overbought territory, locate the tops that were created, and simply buy once they are violated by 1 or 2 ticks. Now, if you had just taken the very first trade here at 106, well, you went up to 122. That's roughly 15 or 16 points in the next month or two. That was from the beginning of the year all the way up till the end of February. How about DUK? Okay, and we were above the 50-period moving average until we crossed below right here. This was at the first or second week of February. Once you have 2 or 3 closes, now we know that we have consecutive closes below. We know that we're only looking for short setups. So what's our setup? Our setup is to identify when we are in the so-called oversold, starting right here, and then locate all of those short-term bottoms that were created in the so-called oversold territory. Remember, there's no such thing as overbought or oversold. We're simply going to exploit it. So you could have sold short on the very first trade below the so-called bottom there, and that was at 82, and the stock went down to roughly 74, 75, 5 or 7 points in the next 3 weeks. And DLTRs. We see here we're above the 50 coming into February. We identify the overbought conditions, simply look for the short-term tops, and those are our entry points. Now, if we go above here, this was up to this past week. If we go above here, which I believe is roughly about 81, 82, well, that's another signal to go long again. But we have to be trading above here to generate any more buy setups. All right, those are stocks. Now, the same technique can be used on commodities. We see here an older chart of heating oil coming from the end of the year all the way up into February. A lot of people lost a lot of money trying to trade heating oil and crude oil. They were trying to pick a bottom. As we all know, that oil was really just falling out of bed at the end of the year. It kept going lower and lower and lower. A lot of traders lost money trying to pick a bottom. Remember, we do not ever try to pick tops and bottoms the way conventional wisdom taught. We try to go with them. First thing we do is we ask ourselves, where is price, regardless of what market or time frame, where is price in relation to the 50 period? Well, obviously, heating oil was below. In fact, I think heating oil was below its 50 period going all the way back to August or September. So there's none of the traders at Specialist Trading were even considering going long heating oil because of that simple rule. You see how I said if there was only one rule or technique I could apply if I were stranded on an island, it would be this 50-period moving average. I'm going to show you it in different time frames on intraday trading as well as weekly and monthly trading. You'll see it applies to all time frames and all markets. So if heating oil has been going lower, well, we want to exploit the so-called oversold conditions here in November and December and in January. We identified the bottoms that were created, and those are our entry points to go short. So when everyone was losing money trying to pick a bottom in heating oil and or crude oil, the same scenario existed, we could have just simply gone short. All right. Now, obviously, nothing stays the same forever. Obviously, there's some fits and stalls, and as we see here, that heating oil kind of stopped at the end of January and started to rise. Well, once it did, well, we just reverse. Now we look for the so-called overbought conditions. We look for the tops that were created in the so-called overbought conditions that were above the 50. And there's our point to enter. All right, so we're not going to, every trade is not going to be a winner. Obviously, your last one is probably going to either break even or lose a little. But then you just simply reverse, stop and reverse, and go the other way once price trades above or below the 50-period moving average. It goes in the opposite scenario. Now, that's commodities in heating oil. Let's go to some intraday trading for the E-mini S&P, just to show you another market and another time frame. Here's a 60-minute chart of the E-mini. going all the way back, I believe, to February. This was February 11th, so it's about a month ago. Okay, on an hourly time frame, we see here that price crossed above the 50. At this point, we had consecutive closes above. So now we're looking only to go long the E-mini. We don't care what's going on in the world. We don't care if some jobless claim came out or some economic indicator. We don't care about those things. Everything you need to know is right in front of you on the chart. If price is above the 50, you should only be looking to buy. That's it. Once price goes below the 50, then you look to sell. We don't just simply buy or sell when price crosses above or low. We don't buy at the market and sell at the market. We have to wait for some structure. But those are the things we teach you in our courses, and such as what I'm teaching you today. I'm teaching you structure for an entry technique. All right, so since we were above the 50, we know we're going long, so we want to exploit so-called overbought conditions. Here are this so-called overbought scenario. Even though we know there's no such thing as overbought, we want to exploit it. We identify all the tops, and I think it would have been easy to go long the E-mini on a 60-minute time frame. This was about a month ago. You could have taken the first setup at 20-30 and made a quick 50-60 points in the next week simply by using this technique. How about a 30-minute time frame? Let's go to a smaller time frame. Okay, this was just, I believe this was last week on the 10th. This was just a week ago. Price was above the 50-period moving average on a 30-minute time frame. Okay. It's above, but the oscillator is not telling us that we're in an overbought condition. So there's nothing really to do here until price has consecutive closes below the 50 period. And guess what? We now are in the so-called oversold area on a 30-minute time frame. Remember, we're oversold right here at 2065. Look how much further we kept going lower and lower. 30 points on the E-mini while we're in oversold. I mean, see how silly it is to try and pick a bottom when something tells you that it's oversold? There's no such thing as oversold. A market can go lower and lower. 30 points on the E-mini. I don't know if that transfers over roughly in about 200, 250 points in the Dow. Could you have stayed long 250 points on the market as it continues to go lower and lower? It's much easier just to simply go with it. But how do we know which side to be on? A simple rule, follow the 50-period moving average. All right? And it told you well in advance before that sell-off that we were most likely going lower. So all we have to do is locate the so-called oversold area and then identify all of the bottoms that were created in the so-called oversold area on this 30-minute time frame, and then simply exploit them. Go short once we trade 1 or 2 ticks below. If you'd just taken this first one here, about 2065, look what happened, all the way down to 2035 in just a day or two. How about yesterday, okay? Just to show you that we're not cherry picking the best and that this only works maybe years ago the way some educators do. They figure, you know, all the best setups were a year or two ago. This happened yesterday. This was on a 5-minute chart of the E-mini, all right? We all know that the market had a really nice move to the upside yesterday, but prior to that, on a 5-minute time frame, we were already above the 50-period moving average. So on the, if today is the 17th, yesterday was the 16th, the day previous to that was the 15th. That was or I should say 13th. That was on Friday. On Friday, we were already above the 50-period moving average. So we already knew that, you know, you should be looking to go long on the 16th. And guess what? The market went up higher. That's okay. All we want to do is exploit the so-called overbought conditions. We can't exploit this oversold condition. Why? Because we're still above the 50. We can only exploit an oversold condition right here if we are below the 50. And we never went below the 50 for the entire day. This is a 5-minute chart. So we identify all the tops, and you think you could have had some nice trades yesterday just using this entry technique. Even if you had just taken the very first one right here at 2060, well, that's a good 15 points by the end of the day. That's $750 per contract, roughly. That was yesterday. Now let's look at the Forex charts, and I want to show you an older chart of the Forex charts, but specifically to show you how some of our members trade this specific technique using different time frames. We don't teach this. This is not a requirement in our courses, but many of our members like to use this technique. Let's look at a weekly chart of the British pound using this technique. Now obviously the first half of this chart, the British pound was going higher. But in the second part, this was last year, last August, September, we crossed below the 50 and started to go lower. So if we apply the first technique, here's all the instances you could have gone long. These are literally, on a weekly chart, these are thousands of dollars of nice trades here. But once we cross below, well, then you just exploit the downside the same way. Now the trouble is, a lot of people don't have the funds or the account size to trade a weekly chart, to hold positions overnight that long and to take the risk. So what many of our members do, will use this 50-period moving average setup on a weekly chart and say, I want to trade a smaller time frame. Since the weekly is below the 50, I want to go down to a daily. And once the daily gets below the 50, well, that's when I apply the same technique to go short. Okay? Now, let's say you still don't have enough funds to trade the daily. Okay, well, looking back here, if the daily is below the 50-period moving average, well, then you can go down to a 4-hour time frame. Many Forex traders like to trade 4 hours, and wait till the 4-hour gets below the 50 and use the same technique. Okay? So you can use the higher time frame if you want. This is not a requirement, but if you want to tell you what to do on the lower time frame. But you see how well this technique works in any market, any time frame, any direction. We just showed you a weekly chart, a daily chart, and a 4-hour chart. Now, 2 points to remember, extremely important, and these are what my mentors taught me. Firstly, there is no such thing as overbought, oversold. I can't stress that enough. This is how important this is. You really won't get, in my opinion, get onto that road of consistency until you fully grasp this concept. So many of us, myself included, believe that, well, it's gone too high, too high too soon. It's got to be sold. It's way overbought. Or conversely, it's fallen out of bed. We've never been this low before. You got to buy it here. There's no way it can go any lower. All right? This is a concept that for some reason is ingrained in us in the beginning when we're just learning how to trade, and this is the way we're taught to trade. Conventional wisdom always tells us something is overbought, you sell. Something is oversold, you buy. But trust me when I say this from firsthand experience, there is no consistency to this type of trading. Remember, we are looking for consistency. I know tons of traders who traded this way and made hundreds of thousands, if not millions of dollars. And guess what? They've given it all back. So we don't want to teach and mentor students some fly-by-night system that promises the world and then has you give it all back. What we're trying to do is instill consistency in you so that you can be trading 10, 20, 30 years down the road. If you want to trade that way, if you want to see yourself still trading with a nice account size 30 years from now, my personal opinion is never ever try to trade tops and bottoms. Okay? These are the 2 points I really want you to remember. And I'm saying it from firsthand experience. I'm not looking down or talking down to anyone or trying to be condescending or arrogant. I'm saying it because the first 2 years of my trading career, I struggled tremendously because I traded like 99.9% of most traders do, trying to pick tops and bottoms. Okay? Now, in closing, I want you to ask yourself this and ask yourself honestly. Do you think any of these edges that I shared with you today could have helped your trading this past year? I'm sure some of you may be saying, well, Steve, I have a technique that works and I really don't trade this way. I appreciate the information, but this is not my cup of tea. This is actually not the way I trade anyway. I trade pullbacks or I don't trade this at all. Okay, but what about the 50-period moving average? Now, I can almost guarantee that that one technique alone could have saved you a lot of losses this past year. In fact, I dare you to go back and look at your last 10 or 20 trades and look and see where your winners were and your losers were while applying this 50-period moving average. I can almost guarantee that the reason why you had most of your losers take place was because you were buying above the 50-period moving average and selling below. So even if you had just used that, you think it could have helped your trading this past year. What if I could give you 3 or 4 more edges just like these, just like the ones I shared with you today, but entirely different? What about 5, 6, 7 more edges like this? Well, here's what we're offering all of our attendees today. This is a great offer. It's a video recording of my Secrets of a Stock Exchange Specialist training sessions. About 2 years ago, I was asked to speak at a conference. I was the headline speaker at a conference in Denver. Okay? They videotape the entire presentation, and it's 3 hours of me speaking, giving you many more edges such as what I just shared with you today. More high probability trading edges. I also tell you which indicators to use, which ones not to use. I go into the difference between the strategy versus a system. I also share with you the #1 chart pattern you should be looking for in all setups, regardless of what strategy you trade, regardless of what direction, and regardless of what market. But I think probably The most important thing I taught in this course, on the video course, is strategy number 1. It's probably our most consistent, at Specialist Trading, our most consistent pullback course to date. Let me show you some recent signals that were generated using strategy number 1 and that our course members were eligible to take. Here's a couple of buy signals in urban. Now, if you recall, the technique I just taught you last hour was an entry technique based off of prices going higher and buying while they're going up, and also selling while prices are going down. What strategy number 1 does is determine what the trend is, the overall trend, and then it buys on sell-offs or pullbacks, but within the trend. Because I can see some people might write up saying here, well, Steve, how come you pick the bottom here and pick the bottom here? Our specific rules tell us when we are in an uptrend, and then we look for the pullbacks within an uptrend. So these were 2 actual signals generated using strategy number 1 to go long. Now, it also will tell you when the overall trend is down and give you selling signals to go short on these pullbacks to the upside. So as you can see here in NRG, each and every one of these nice little rises in price generated a sell signal to go short using the same exact rules. Now, this is with stocks. If we look at weekly chart of the E-mini, we can see here that going back to 2014, the beginning of 2014 up until the beginning of this year, these were all buy signals generated using strategy number 1. Now, we can apply this to a weekly chart. We can also apply this to a 5-minute chart. This was just about 2 weeks ago, the end of February, on a 5-minute time frame. As you can see here, we had a sell-off, and right here on this low of this second bottom here, we generated a buy signal. Then another buy signal was generated. As the trend changed, we started generating sell signals. And then finally, a weekly chart of the dollar-yen. All right, this is going all the way back to October of 2014, but wouldn't you have liked to have gone long, or known to have gone long the dollar-yen right here at the very bottom before this tremendous run-up? Now, none of the rules have changed regardless of what market we're trading or what time frame. The same exact rules, and it's all explained in this course. This is a ton of great information, 3 hours of information, many more high probability trading edges, as well as all the rules to strategy number 1. Now, as I stated earlier, Pro Trader Strategies is our sister site. They market and promote all of my courses, all of my techniques, all of my video seminars. Now, on their website, they market this for roughly $1,000. That's how much information is in the course and how valuable it is. But for all the attendees today, we are dropping that price down to $37, if you can believe that. I'm sure many of you probably spent more than that just trading today, even with commission costs. And if you even think about it, I don't think many of us can go out to dinner for less than $50 or even $100, depending on if you're going fast food or even a restaurant. So all this information is just a valuable amount of information, as well as all the rules to a full-fledged strategy for only $37. Now remember, I gave you today's technique, which is not even in this 3-hour video. This is something entirely separate. But today's technique was just an entry technique. Strategy number 1, I give you the entry. I also give you the stop placement. I also give you the exit placement. I also teach you conservative as well as aggressive ways in which to trade it. So there's tons of information here. So if you're interested in taking advantage of this, extremely low price, here's how to do this. You can contact Pro Trader Strategies. Any one of their trading consultants can be contacted by emailing them at trading@protraderstrategies.com. You can call them directly at area code 310-598-6677. But the best way is simply to go to the link that has that $37 offer on it. As you see here, it's right below the phone number. You can copy and paste that onto your browser, but probably the simplest way to go onto that sign-up page is just to look at your right-hand column there on your GoToWebinar page. And if you look under the chat box, you'll see that they've actually posted the link there. So you can just click that on, and it will automatically open up a browser and take you to that page. So you don't have to cut and paste anything. You can just simply click that on. Remember, $37, but it only runs for the next couple of days. This is a limited offer because after that, it goes right back up to $997 on the website. So I don't think you can beat that low of a price. You will have everything up and running. This is not a disc that's sent to you. It's an online course So it's something that you have at your disposal whenever. You can watch it at work on your iPhone or your iPad. You can watch it at home at your own leisure, but it's yours to keep. Also, a number of people have often wondered, well, Steve, is this something that expires after a couple of weeks? No, it's yours for life. And you also get my personal email address where you can contact me whenever you'd want. So all this is included for that deep discounted price of $37. Now we have about 10 or 15 more minutes left, and I want to thank you. If anyone had any questions, I'm going to open up the question and answer box. And remember, if you want to lock in that $37 deal price, just click on the link as you see here in the chat box, and we'll take you directly to that page, and you will be able to simply sign up and be up and running in a matter of moments. Let's see here. I see we have some students already that are members of Specialist Trading, Mahmoud and some other people. Thank you for joining us today. Let's see. Do you track for a stop purpose a shorter term moving average than the 50 for possible exits? This is from Ephraim. That's a good question. I think what Ephraim is asking is that many people like to use a smaller time frame of a moving average, such as a 5-period moving average. And what they'll do is, if you're long, once you enter into the trade, you simply monitor where price is in relation to the, let's say, a 5-period moving average. If price closes below that moving average, well, oftentimes you'll want to sell at the market, or many times you'll place your stop just below that low. That's one of the techniques, and we talk about that in our courses. And you can obviously use that if you want. There's nothing wrong with that technique. It's up to you. Remember, what we want to do is present you with a ton of information. That's just one of the pieces of the puzzle. That's one stop technique. But ultimately, we want you to decide. In other words, we're giving you all the ingredients to make the meal that you want. And then we're staying with you there and making sure that you progress nicely. And if you want to change and substitute anything, you can. That's what we do. It's not our philosophy to say, this is our system, this is the way everyone trades, everyone has to take the same signals, everyone has to exit at the same place, everyone has to trade the same market, everyone has to trade the same time frame. I mean, that's not the way trading should be. It's been my experience that when that happens, most traders fail because everyone brings something different to the markets. Some traders like to trade conservatively, some traders like to trade aggressively, some like the long term, some like the short term. So since that's the way people are, it's silly to force everyone to trade the same way. You're ultimately just going to get a bunch of failing trades. So we want to give you the ingredients so that you can construct your own recipe for trading. Okay? So to answer your question, Ephraim, yes, there's nothing wrong with that. That's one of the stop placements that many of our traders use, and that's perfectly admissible. Dave is saying, so everything is all price action. Yes, pretty much, Dave, all of our courses and strategies are based off of price action or indicator based. But they're extremely simple. Most of our strategies, we have upwards of 10 in all markets. Most of our strategies employ maybe 1 or 2 indicators at most, and then maybe 5 or 6 rules at most. And they're extremely simple. You know, if you look at people who have been trading for a relatively short time, 5 or 10 years, which is really relatively short, most of their trading plans are extremely complicated. There are a lot of convoluted logic, a lot of this condition cannot happen until this other condition is met, and everything has to line up in place. You have to wait for the news announcement, you have to wait for the indicators to cross, you have to wait for the full moon. It doesn't matter what, but everything has to come into place before you can buy or sell. Okay? It's too complicated. If you look at most of the traders who've been trading for 20, 30, 40 years, most of their plans have maybe 4 or 5 rules at most, tops. And that's the way our plans are. They're extremely simple to learn. It's just the process of being able to implement them correctly. So most of our traders stay with us for a good few months or so just to learn to understand the process with me guiding them. And then they're on their own. We don't have to, you know, you're always a member. You can always come back whenever you want for a tune-up course, but there's nothing you have to stick around for. You know when a signal is identified because you're relying on your own judgment because now you see how well it works. So most of our strategies are either indicator-based or pattern recognition or, you know, everything is in price. Derek says, unfortunately, you missed the first 45 minutes. Yes, there's a recording link. You can contact the people here, either use their email or the phone number, Derek, and they will send you a link. Okay. Todd says the 50-period simple moving average is a major part of my trade plan. I'm glad, Todd, because honestly, I mean, I'm a trader first myself. I'm an educator as well, but I'm not a salesperson. I'm really telling you what I use and what's worked for me, okay? Because I trade myself on a daily basis, and the 50-period is probably the most valuable tool I could ever share with anyone. The 50-period is not something magical. It's not a magic number. It's just really a guideline. Remember, just because price is above the 50-period, we're not going to buy. We don't simply just buy at the market. And just because price goes below, we're not going to sell. That's not the proper use of it. The proper use is just to see if price is above, well, then we only look for buy setups. That's it. And it can be your strategy. It can be another educator's strategy, but that's all. It doesn't have to be one of mine. And if price is below, we're either going to sit out. If we don't like the short, we're going to stay on the sidelines, or we are going to look for short setups with whatever technique you want to use. It could be something you've come up with. It could be, you know, one of another educator's or one of mine. It doesn't matter. It can be transferred over into any market and any time frame. I showed you how well it works on a 5-minute chart. I showed you how well it works on a daily chart. I showed you how well it could have helped you with crude oil and heating oil. And then I showed you on currency pairs. It's a great tool. I'm not saying that it's, 100% correct. Many times you may have some small losers here and there, but that's normal. That's perfectly natural. It's like asking an athlete to hit the ball 100% of the time. It doesn't happen all the time. But what we're looking for is consistency, and this is the most consistent tool I could ever think of. Okay. Shadri asks, is this webinar strategy works for day or swing trading Forex? Yes, it does. I showed you a number of examples. I showed you the Swiss franc. I also showed you the British pound, how well it works. Yes, it works well for trading the Forex. And I showed you intraday charts of the Forex as well. So we have a number of members who use this on intraday Forex markets as well as daily and even weekly charts. Let's see here. Gary asks, does strategy 1 work better with daily or weekly charts? Thanks for the webinar. Gary, since we're not a systematic company where we keep records, all we can go off is what our members tell us. And we have members that only use it for long term, and we have other members that only use it for intraday. So really the answer is up to you. All we know is that it has consistency in all markets, but there's no way to say whether it works better. We have some people that swear by it that use it on 5-minute charts. So, remember, once again, no two traders should ever trade alike. That's why, and that's why we can't say, well, it works the best on daily charts, because that would be saying that you've got to use this on daily charts only. No, because everyone has a different way to approach it. So it's really up to you. But remember, we're there with you every step of the way, so you can define and figure out what works best for you. Okay? Remember, if you want to take advantage of this $37 deal, this is only running for the next few days. After that, it goes back to the full price of $9.97. I really don't think you can get as much information and a better discounted deal at $37. There's so much information in here, you really have to take advantage of it. And trust me, $37 is not something, we're showing you in good faith that we want to educate you, and we don't just want to blindly take your money. We're trying to educate you and be fair about it, okay? Dave says, yes, it's brilliant. Thank you. Thank you for this entry today. Interesting that there is no such thing as overbought and oversold. Thanks, Steve. Well, thank you, Dave. And remember, that's a concept that I have to be honest, it was difficult for me to grasp at first. I mean, in fact, I didn't want to, because I had always been taught, well, okay, I went to this seminar and this guy showed me that when these indicators cross, look how perfectly it works. Everything goes down, and then when they cross on the bottom, look how perfectly it works. Everything goes up. And so I thought this is the way markets worked. And I saw how it worked in all different time frames, and I thought, boy, these are the keys to the kingdom. Until I started trading it. And as I stated, it would work every once in a while. I'm not saying that that doesn't work. It does work every once in a while. But there was no consistency. You see, techniques that work every once in a while will not sustain you. We want things that will sustain you over time. So that's what we're trying to instill in all our members. I'm not going to sit here and promise you that all of our methods work 150% of the time. They don't. We always go into some small minor losses from time to time. But over time, we have techniques that have 2 steps forward, 1 step back approach. All right? We're not looking for home runs, although they may happen every once in a while. We're looking for a 2 step forward, 1 step back approach, because that's the approach that has sustained me to be able to trade for 38 years. And that's what I'm trying to educate in all of my students. So I'm glad you like this technique. Once again, this is not something I came up with. This is what was taught to me on the floor some 30 years ago as well. Chaudhry asks, I meant the strategy that I have to buy from above link, and do you have other programs? Yes, we have many other programs at Specialist Trading. We're just trying to share with you in good faith to give you a lot of information and share with you at a very inexpensive price, just to show you in good faith that this as well. But we have other strategies that work tremendously for swing trading, as well for intraday trading, as well for long term. I think if you're interested in those different ones, the best thing to do would be to contact, either email or call the trading consultants at Pro Trader Strategies. They can help you best with that, okay? I would just say going up the next level, strategy number 4 is our most popular strategy. I don't want to get into it, what that's about, because we have limited time now, but after strategy number 1, strategy number 4 is probably our most popular strategy to date. So if you're looking for something else as well, that would be the one to ask for, okay? DT asks, is the strategy demonstrated with charts on the $37 video? Yes, it's a 3-hour video presentation of me showing charts and screenshots of exactly how to implement this. Lots and lots of information in that, okay? Let's see here. Chaudhry says, thank you so much. You're more than welcome. A lot of people are asking what remember, the stochastic tool I used is just something, that you can use. I didn't change anything. I don't know what the actual parameters are, because in order to know what the parameters were or the settings, I would have had to open up the edit box. And I didn't. I just looked down, opened up the window of indicators. I saw slow stochastic, and I just clicked that, and that plotted on my screen. The only thing I can tell you about the actual overbought, oversold parameters are that the overbought threshold is at 80, and the oversold threshold is at 20. But in terms of the actual parameters that make up the slow stochastic, I don't know. I didn't open up the actual, Terry, I didn't open up the actual edit box. And that's one of the things I'm trying to show you. It doesn't matter. It doesn't matter whether you use slow stochastic, whether you use fast stochastic, whether you use RSI, momentum, or whether you use Williams stochastic oscillator. It doesn't matter whether you use something you've made up. It doesn't even matter if it's based off the tides of the ocean. All we're looking for is for something to tell us that the markets are overbought, oversold. And then we're going to exploit that, okay? Because what have we learned? There is no such thing as overbought, oversold. So ultimately, it does not matter what indicator or tool we're using, just as long as it tells us the market is overbought, oversold, okay? Tina has put up some stochastic settings up there, and that's fine, Tina, if you wanted to use that, okay? Remember, it's not, but the point is, if you have any indicator you can experiment with, now that you know the rules to this entry technique, as long as it gives you an overbought, oversold tool, oversold setting, that's all you need to know, okay? In closing, I just want to thank you so much, but remember, I know a lot of you go to different presentations and webinars. I don't think you're going to get as much information as I provide in this 3-hour training session for such a small, inexpensive price. Once again, you can't even go out for 2 people for dinner for less than $100 these days. This is only $37. But if you want to take advantage of all this information plus a full-fledged strategy, all the rules, entries, exits, lots of examples, and it's yours to keep. It's yours for life. It's not something that expires. Please take advantage of this $37 deal. You won't be disappointed, and you have my email address as well. You can contact me with questions for life. You're now a member of Specialist Trading, okay? In closing, remember, if you have any questions, contact the good people at Pro Trader Strategies. They can answer any question you may have. They can help you sign up for this $37 deal, but remember, that's only going for a couple of days. Thank you so much for attending on this St. Patrick's Day. Thank you so much for viewing this presentation. I hope you get some use out of it. I hope you can use some of the edges I shared and taught you today. And in closing, take one last look at our disclaimer, and I look forward to all of you becoming members and students of mine at Specialist Trading. Thank you so much. We'll see you next time. Bye-bye.